Education tax benefits. Few advantages are sought after by parents for their children as an education that will enable them to grow professionally and enjoy the benefits such an education can help bestow. Education and income are highly correlated. Although there are significant exceptions, on average, an individual with a bachelor's degree has an annual income about twice that of an individual armed only with a high school diploma, and that gap, in terms of both percentage and dollars, appears to be widening. To encourage getting an education, the federal government offers various income tax incentives. We will spend the next couple of hours examining these incentives and will cover 1. Qualified tuition programs, 2. Coverdell education savings accounts, 3. The Education Savings Bond Program, 4. Federal tax credits for education, 5. The federal tax treatment of scholarships and fellowships, and 6. Deductions available for student loan interest. Upon completion of this course, you should be able to, first, identify the features and tax benefits of qualified tuition programs available under Internal Revenue Code Section 529. Second, recognize the limits and tax treatment of contributions to and distributions from a Coverdell education savings account. Third, identify the tax treatment of interest earned under qualified U.S. savings bonds used to pay education expenses. Fourth, apply the American Opportunity and Lifetime Learning Credit rules. Fifth, recognize the tax treatment given to scholarships, fellowships, and other types of educational assistance. And lastly, apply the federal income tax rules applicable to the payment of student loan interest. We'll begin our discussion by looking at the correlation of education with earnings and the likelihood of being unemployed. Among the benefits normally flowing from a higher level of education is a bigger income. Whether or not a higher level of education is actually responsible for an increased annual income in the case of any particular individual, there is a very clear positive correlation between education level and earnings. Specifically, according to U.S. Bureau of Labor figures, a person's increased level of education and his or her annual earnings, as well as reduced unemployment rate, appear to be related, as noted in the chart as you can see on your current slide. One of the most popular education programs is a qualified tuition program, usually referred to simply as a 529 plan. So let's start there. Qualified tuition programs are programs offered by each of the 50 states and the District of Columbia. Under these programs, a taxpayer can contribute funds for the purpose of paying a designated beneficiary's qualified education expenses at an educational institution. In addition, a group of private colleges offers a prepaid tuition plan referred to as an independent 529 plan. A qualified tuition program can take two forms. First, a prepaid tuition plan, which can be a prepaid unit plan or a contract plan, or second, a college savings plan. Under a prepaid tuition plan, a taxpayer pays now for future education. This allows a taxpayer to lock in the costs of attending college at their current levels. Prepaid tuition plans may be, first, prepaid unit plans. Under that arrangement, a taxpayer buys units for each unit represents a fixed percentage of tuition. For example, one unit may represent 1% of a year's tuition. In these plans, although every buyer pays the same price, the price of a prepaid unit generally increases annually. Or second, contract plans. Under a contract plan, the taxpayer agrees to purchase a specified number of years of tuition. Contract plans are generally priced so that the purchase price is smaller when the plan beneficiaries are younger children. Pricing of contract plans assumes that, when plan beneficiaries are younger children, more time is available for the institution to invest the funds before the beneficiary actually attends college. Prepaid tuition plans offer a number of advantages. The most important among them are the following. 1. They provide a hedge against inflation by permitting taxpayers to effectively pay for future education at current rates. Second, they offer guarantees against the need to pay increased tuition. Third, they involve little or no risk to the taxpayer. And fourth, they normally outperform traditional savings approaches. Although prepaid tuition plans clearly offer several significant advantages, they also involve some drawbacks like the following. First, participation in a prepaid tuition plan may be available only to state residents. Second, if the beneficiary attends a private college or a college outside the state in which the plan is established, the amount contributed to the plan may not be enough to cover the college costs. Third, alternative approaches. A college savings plan, for example, may offer the taxpayer an increased return over an extended period of time. Fourth, withdrawal from a prepaid tuition plan could result in the imposition of a cancellation fee and/or loss of interest. And lastly, for many families, the biggest drawback may be that the prepaid tuition plan can adversely affect the amount of financial aid available to the student. Not surprisingly, college savings plans are different from prepaid tuition plans. Unlike a prepaid tuition plan, a college savings plan does not permit a taxpayer to purchase future education. Instead, the taxpayer invests money into a special account established for a designated beneficiary. Earnings on the funds invested in a college savings plan are tax deferred, and if used to pay qualified education expenses, are entirely tax free. The funds in the plan, including the tax deferred gain, can be used to meet qualified education expenses at any accredited U.S. college or university without the need to recognize income. In addition, two recent laws added to the list of qualified expenses. A provision of the Tax Cuts and Jobs Act of 2017 broadened the definition of qualified education expenses to include elementary and secondary school tuition not exceeding $10,000 annually. Under the tax provisions, no K-12 education expenses other than tuition are considered qualified education expenses. The Secure Act, which became law in December 2019, expands the definition of qualified higher education expenses applicable to distributions made after December 31st, 2018 to include, first, expenses for fees, books, supplies, and equipment required for the participation of a designated beneficiary in an apprenticeship program, and second, principal or interest paid on a qualified education loan of the designated beneficiary or a sibling of the designated beneficiary in an amount not exceeding $10,000 in the aggregate. The deduction otherwise allowable for education loan interest is reduced, but not below zero, by the amount of the distributions treated as a qualified higher education expense. The term sibling means a brother, sister, stepbrother, or stepsister. College savings plan advantages include: first, administrative simplicity, since college savings accounts are easy to establish and are professionally managed. Second, control of the plan remains with the contributing taxpayer, irrespective of the student beneficiary's age. Third, flexibility, since no rules prescribe when assets must be used or specify an age before which accounts must be established. And lastly, often most important, is that financial aid for which the student would be eligible is normally unaffected by the college savings plan, since plan assets belong to the contributing taxpayer rather than the student. The drawbacks of a college savings plan, when compared with a prepaid tuition plan, include the following. First, the contributing taxpayer bears the investment risk associated with the account. Second, there is no guarantee that the college savings plan fund will be sufficient to pay the beneficiary's college costs at the time used. And third, account fees imposed tend to diminish the account's total returns. Contributions to a qualified tuition program can be made by anyone, regardless of their income level. Furthermore, the contributing taxpayer need have no relationship at all, familial or otherwise, with a designated student beneficiary. Although individual state college savings plans may impose specific dollar limitations on the amount of contributions that may be made for a designated beneficiary, $250,000 adjusted annually for inflation, for example, federal law is less specific. Under federal guidelines, the contributions made to a qualified tuition program for any beneficiary cannot be more than the amount needed to provide for the beneficiary's qualified education expenses. Several rules affect qualified tuition programs. Those rules impose the following restrictions on them. 1. Contributions may only be made in cash. Contributions of securities or other forms of property are not permitted. 2. A separate accounting must be maintained for each designated beneficiary. 3. A contributor may change the investment twice each calendar year, and at any time a beneficiary designation is changed. And 4. A plan cannot permit any interest in the program to be used as loan collateral.